Hey everybody, Real Estate Ninja here. I hope you're doing well. If you're new to this channel and you're used to the Economic Ninja channel, please hit the subscribe button and the thumbs up. I'd really appreciate it. Got a big warning for you today, and this is following 2006 very well. You see, in 2004, interest rates had been coming up steadily because the Federal Reserve started something called the dot plot plan, and they started incrementally raising mortgage rates or interest rates, which brought up mortgage rates because the housing market was getting overheated, and it soon started to turn. But what happened in that time period, people switched from 30 years to what you hear about all the time is these ninja loans, these negative amortization loans, all these crazy terms that were out there. But what you don't realize is that in between those two periods, there was a boom in adjustable rate mortgages. The reason why is because they were cheaper than 30 years and they sought an alternative. And so that is happening right now, and I'm going to share a story that is very, very important. I'm going to link it below, but I want people to understand the very serious hazards of what is happening right now. The other day I went online, and right as a 30-year fixed mortgage was cresting 6%, I saw that a 5/1 ARM was just under 5%, okay? So a little over 1% difference. And I knew then we were going to see a shift into adjustable rate mortgages, and what people don't realize is they're going to get into a major trap, all right? So right here, this is part of the trap, all right? Because those mortgages are not going to come down anytime soon. And CNBC is one company that's already advertising this because why? They want to get clicks and they want your attention. So check this out. This is the title. Adjustable rate mortgages have risks, but can save you money, and demand for them has tripled since January. First off, think about this. They just said they have risks, but they could save you money. That's going to get the person hooked, right? Because there's so many people all around the world, or around the country, that want so desperately to own a home. They want the American dream, and they're afraid that they're not going to be able to get in unless they find an opportunity right now and dive in. And they're actually committing, in my opinion, non-professional advice. I'm a horrible real estate agent, by the way. I've been a real estate agent, owned a brokerage. My best part of real estate is actually investing in properties and finding opportunities that people don't see. That's why I started the side hustle course, because you need to be able to see opportunities that other people don't. And that's why I put a whole real estate portion in that course, because I want people to really consider all the risks before they do something that could hurt them. But look at this. Demand for a ARM has tripled since January. Why? Because rates keep going up, and they're going to keep going higher. In my opinion, I believe you're going to see an 8% mortgage sometime by December, and the reason why is the Federal Reserve wants the Fed funds rate to be at 4%. That's almost double from where it is today. So to say that a mortgage at 8% is likely is an understatement, in my opinion. It says adjustable rate mortgages, or ARMs, are making a comeback, but whether or not they make sense for you depends on how much risk you can handle. These types of loans, also known as variable rate mortgages, are different than traditional fixed rate mortgages because the interest rate you can pay can change at various points over the course of the loan. Let me explain that. A 5/1 ARM means that it's a fixed interest rate, mortgage rate, for 5 years, and then it adjusts. And there's all types of different ways it can adjust, and how it follows different patterns. It used to be that, and there always is a cutoff point, a highest point that you can pay interest. When I was doing adjustable rate mortgages, it was 6 points over the prime rate that the loan started at. So let's just say prime was at 3. It could be capped at 9%. It's very dangerous because the problem is in the last 20 years, we have seen nothing but low mortgage rates. As a matter of fact, we've seen the lowest mortgage rates in the last century. This is not normal. A normal mortgage industry where an economy is prospering, mortgage rates should be around 8, 9%. I know that sounds crazy, but it's because literally the last 20 years, this is the environment you've been raised in. And it has bred excessive money printing, and it is going to breed horrible, horrible high inflation rates, all right? And so that is going to flip, and I believe it's going to flip in the wrong direction, and you're going to see much, much higher mortgage rates in the 1980s, early 1980s, we saw mortgage rates topping a little above 18%. And that is because inflation was in the low teens and we had to get it up there. So I believe that you're going to actually see, I believe, in my non-financial opinion, that you're going to see not only double digit, but over 20% mortgage rates at a certain point because of the need to fix the inflation issue, all right? When that's going to happen, I don't know, but I believe that you're going to see that. It says ARMs offer introductory rates that are often cheaper than fixed rate loans, currently about 0.5% to 1.5% difference. These introductory rates are locked in for the first few years of a mortgage, usually 5, 7, or 10. But I also want to stop. I have before seen 1 year and 3 year ARMs. And I believe that people are going to dive into those 1 and 3 years thinking, hey, it's short term, we're just going to refi as rates come down and the Fed pivots. But the Fed's been very clear that they're not planning on pivoting. So I want you to think about that. I'm going to link this story below, and I think it's very, very important that people start to wake up to the realities that are happening in the industry. And what I want you to see is I want you to start looking at this as an opportunity, not as a time that you're going to miss out. All right, guys, I hope you got something out of this. With that being said, the Real Estate Ninja is out.